Good morning, traders. It is 8:02 a.m. Chicago time on Monday, the 22nd of August, 2022. Thanks for joining me on this episode number 2298. Derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, we have a risk off across the board sentiment. Looking at the Convergent Trading's pre-market summary sheet, we see that the posture is risk off. It's pretty deep. We also see pretty steady selling across the major players here, the behemoths of the market. Here's the pre-market percent change heat map. And you could see that Soft and Google, which are the biggest players, along with Apple, are all, 160, 150, 160 to 180 basis points down. Amazon, 212 basis points. Tesla, 200 basis points. These are all kind of heavy right now, weighing heavily right now, and have an impact on the Nasdaq as well as the S&P, and pretty much across the board, these are the big players that everybody holds in their portfolios. So that's what we're coming into today. The main play here being that there's discussion with Jackson Hole coming up. There's discussion that the Fed really has to deliver a strong hawkish posture with 75 basis points in September, raising rates again so that there's a pause in November during the election month. Generally, the Fed has historically not made big moves during an election month to avoid being seen as politicized. So the only time to deliver that is really in September. So the expectation is they're very likely to come out and talk about interest rate inflation being too hot still, and the Fed being forced to make a strong push for higher interest rates. China surprisingly cut rates overnight, and that's what we have. I mean, the week ahead is relatively light. We have had and don't have any major numbers today. Any high tier numbers. Tomorrow, the high tier numbers across the G7. Tomorrow we have the S&P Global Manufacturing PMI for Germany. And then we're looking at the one from Great Britain as well. New home sales come in for the U.S. at 10 tomorrow. Wednesday, durable goods orders from the U.S. Thursday, the German IFO business climate and the U.S. GDP growth rate. And on Friday, we have German's GfK consumer confidence, personal income, personal spending on from the U.S. And then on Friday, we have Fed's Powell's speech, where he is expected to be relatively hawkish. That's at 10 o'clock on Friday. The market will be anticipating that. So pretty much a quiet-ish week, but with Jackson Hole in play and this leak, so to speak, that Jay Powell has to come out and be hawkish in preparation for the next couple months, and the midterm elections has the markets a little bit jittery. The fact remains that if there's an expectation of 18 times earnings on the S&P, with earnings already guided and expected, the 4,300 handle to 4,300, 4,350, which we've already hit, is a tough on a macro level for those people who trade on a kind of a fundamental view, the bigger fund types. The 4,300, 4,350 in the S&P has been a real cap, and we saw that. We did talk about this all week last week, and the week before that, actually, I was talking about how 4,300-ish is likely to put a cap on rallying, and we saw the turn. So to me, this is likely to continue to explore lower. The S&P is likely to repair some of the structure. We'll look at it in a minute on the way down. So everything is off this morning. There's also this escalation in Russia-Ukraine. Ukraine attacked locations within Crimea, which is now a Russian territory. A nuclear power plant is at risk here, so all of it adds risk premium, which means prices have to revalue lower. Looking at the dollar is the only thing that's up right now. We see interest rates, Treasury futures falling, so yields are rising slightly, which is dollar friendly. One thing I want to point out in the chart in front of you, take a look at the rotations. They have been updated for the week. They're updated once a week and posted in detail to Convergent Trading members every Sunday night. We see the ES has dropped once again. We see that rotations have been falling. Of course, this is looking back 20 sessions. The first standard deviation from the mode of rotations went from 650 to 625. And NASDAQ, I think, dropped from about 2750 to 24 and a quarter. The Russell 3.6 or 3.9 to 3.4. The Dow from about 43 to 39, and crude from about 41 cents to 40 cents. This is basically your 1 minute harmonic for each one of these products. This is basically the ebb and flow, the back and forth, the breathing room for each one of these products, meaning that on a 1 minute chart, not that I trade on a 1 minute chart, but on a 1 minute chart, the S&P is considered rotating normally within about a 6-point range. Okay, so when we're placing our stops or deciding on our targets, this is a significant number. Looking at the S&P itself, we have a multi-distribution profile. We've had a market that is actually a double distribution, has traded a fair amount between 42.21 and about 42.05 or so, and then broke down this morning at about I don't know, something like 4 a.m. Central, broken down much lower and has been holding a lower distribution with a point of control of 41.8150. 100% of the volume is short. 100% of the inventory is short this morning. 216,000 contracts have traded, and the range again is 46 points. The overall range is well within expectations. It's a little higher than the mode, but it's a relatively active trade this morning. So pay attention on the open. We are likely to see some pretty decent back and forth on the open, as this is opening again out of range as we did on Friday. Speaking of Friday, here's what was expected. Let's enlarge this. Friday, we were opening down below at the time. It was around 42.55 or so. The expectation that is that the market's likely to try to be responsive into the 64, and the bias is short. The main trade for Friday was expected to be a push towards 64, expecting the 64 to hold if it even gets there, looking essentially stalking for a short trade no matter what. If it breaches the 64, then the 70-71 becomes key, but the entire focus on Friday is a rotation down to 35. So it's just a matter of where do we want to get short. Where do we want to get short this morning? And the idea is that we're opening in a gap below after an inside day, and this is likely to have to struggle to get back up into and hold the prior range. At a maximum, we expected it to push into the value area low. So this is what was expected. Here's what we got on Friday. Let's take a look at how things played out on Friday. There's Friday's. So here's the multi-distribution day with a very clear point of control right here. Here's the next day. This is Thursday, which was an inside day with the point of control down here in line with the prior day. So what we have here is coiling, right? So what's happening Wednesday, Thursday is coiling, and a break away from here is most likely going to be initiative or directional. Why? Because as both sides trade and form these high, this strong distribution, and the fact that it remained inside, this fight continues to squeeze and squeeze and squeeze and squeeze. And for that volume to show up on the profiles you see here, there have to be, for every contract bought, there has to be a contract sold. Remember, there isn't, in futures, there isn't float. There isn't a company that's issuing or splitting stock or whatever. That doesn't happen here. There's no control or manipulation of the volume in futures. This is why ever since I stopped trading equities in high volume as a NASDAQ SOS bandit trader, when I came into futures, it just was clear to me that this is a much more level game, right? Because the exchange is simply agnostic and it just facilitates trades. It just fills trades. It does not take a position. It doesn't issue shares. It doesn't buy back shares or anything like that. So with that view, with that fundamental view, what that means is for every contract bought, there has to be an opposing party. There's an infinite number of contracts that can be transacted, right? They can be created from thin air and destroyed into nothing just the same. And so with every contract, so for every long, there's a short. And for the volume to take place like this, people have to be positioned. So this is why we call it coiling. It's really winding up, and one side or the other is likely to be wrong. And when they are, they will either cause a certain area to be support, as now they are reducing their risk exposure. Let's say if the shorts were wrong, then it breaks to the upside, then those shorts are likely to create support as they reduce their risk exposure or exit their position. And as it breaks below, in the gap below here, like we saw on Friday, those longs are likely to present resistance as they look to rebalance their risk for the positions that they're holding. These are, I'm only talking about a portion of the volume, which is outright. A good portion of the volume is also hedging, which is what the original intent of futures is. But open interest compared to daily volume tells us that day-to-day positioning is relatively a small amount of the volume that we're trading with. So with that being said, the idea is that if we open in a gap after consolidation, it creates a very important setup, and that setup is you want to look to get short. Remember the 64, that prior day's low. You want to look to get short and then target the areas of the profile that have balance, which at this point was the 35 area down here. 35, and then below there was the 20. Okay, so these are the two key areas, and that's where you get this idea from Friday that any responsive buying is not going to be bought. We're going to look for selling, and we're going to look for that selling to be initiative away from the balance. And as it's being initiative, we're looking to take it back to these to the high volume node, and then we expect it to push into the low volume node on the other extreme, right? The 4220. So that's what was expected. And again, this is what happened. We did push up. We could not quite get into the 64. So we left a tiny little gap here, and then you get this impulse. So if you don't get in on the impulse, the job then becomes about finding a short position with definable risk in the direction of the initiative selling, right? So in that situation, we're looking for a way to get short in the direction of the initiation or in the direction of the impulse. And it did create some opportunities, but it wasn't such an easy trade once the impulse happened. So here it is. Here's what we got. We pushed back up. We got to 61.75. We opened at 59, and then we get this impulse, and we see that there's a collision here. This collision zone becomes key right here. I think I announced it several times for Convergent Trading members in our Mavens channel. I said 44.00 is the LIS. This is a key level now, right? And it remains a key level. And then what we did is we went into a box on Friday, which is tough because a box means that you have to trade from the extremes, and it's likely to cause people to get very complacent with risk. So chop, chop, chop. There were a couple of opportunities that I highlighted in the Mavens channel, that I walked through in the Mavens channel, but really it finally releases, breaks the IB to the downside, and then the best trade of the day really was this mid VWAP pullback for a continuation and break of that low. Again, we're in an initiative market that had already taken out the overnight low. The IB's broken. The flow is to the short side. We look for areas to lean against, and that was that was the key trade of the day. So not much opportunity after that, pretty choppy after that. And then this morning we're coming in, and what we're finding is that, excuse me one second, I just need to cough. What we're finding is that we're staying well below the settlement price, the prior prior settlement price, which is 42.31 or so. We're staying well below, so the inventory is 100% short because we did not trade at all above the settlement price, and this is really driving more selling. So this morning, it's the same kind of theme. We've gotten below the 4,200 century figure. We've got mid and VWAP in that area, mid at 41.9850, VWAP at 41.9375, and to me, this is another situation where we could squeeze a little bit above the 4,200 before we continue lower. Now, the market has moved a fair amount, and let's look at the big picture of where it moved to. Look at where we are. 41.75 is the low, 41.81 is the current, 41.21. So we managed to trade this two-pronged kind of high volume node, if you recall, last week, and then we broke away, and now we are opening way down here versus yesterday. Very big gap here, so weak structure above, and we have a gap zone down here somewhere, weak structure below. What does that mean? It means that there's likely to be a pretty aggressive two-way interaction this morning. This is what we have to take away. We know that the market's flowing to the short side. We know that the big dogs of the stock market, the Amazons, the Apples, the Googles, the Microsofts, and so on, Teslas, they're all selling off 1.5% plus. So the flow is to the overall sentiment and flows to the short side. So overall, we're going to look for areas to get short, probably around 05 or 00, somewhere in there. And then we're going to look to get down into the gap structure. So this is, I've been talking about this for some time, that there is likely to be repair. So here's where we are. We are right at the low of the 10th, this gap day. And so we have a nice gap zone going, pretty thin volume. So this could easily trickle its way down to 41.50, becoming the target, which is only 30 points away. And then the big dog in this area, 41.20. Do you remember the 41.20? You should remember the 41.20 because we've said that number about 6,000 times last month. 41.20 brings us back to the major balance box from way back. No, way back. Yeah, way back right here. This is the key balance and the major magnet. Look at this profile. This profile is profiling everything that's on the screen here, and you can see that we're out of balance. We are in this thin area here, and the magnet is 41.20, right? Brings us back into this balance, brings us back into this balance, and gives us a good base for the next move. And this doesn't mean that the next move will be higher, doubtful, but it gives a good base from which the next move can then gain its energy and move away, expected to the downside in this situation, to continue to do the repairs. These bands that you see here are single prints, weak structure in the auction. The auction blew through these prices and didn't recheck them as it properly does when it has a good basis. So what we're likely to see today is a fight that's looking for 41.20, but because we've moved down a fair amount, we have a gap. There's likely to be some bargain hunting back up. Both sides betting on what the Fed is likely to do next, and what Jay Powell is going to talk about on Friday. So expect it to be relatively aggressive this morning. There's going to have to be some portfolio adjustments and things like that this morning, and futures are a very efficient way to hedge risk, right, because of the margin leverage that exists in futures. So that's what we're looking at. So what's the play today? The key play for today, let me move this up. Yes. Nice. So the key play for today, open auction out of range. We are right there against the low of the 10th, expecting this to pop lower, break that test, expecting this dip to find buyers, back up, and then I'm expecting this thing to just do that. Just chop around all day long. There's so much to be invested here by both sides, and I'm expecting it to fight on both ends. I know that's not an exciting scenario, but that's the likely scenario, that both sides are likely to be exhausted after the IB is in. It's likely to be exhausted. The secondary is an open that tests below, dips in, gives us an impulse, consolidates at the high, and then starts moving and repairing some of this gap on the upside, closing the singles back into 42.21. Basically Friday's low, 42.20.75, 42.21, and then petering out, and then that becomes the I forget the word. That becomes the impetus for buyers to become more encouraged to push back to 35 up here, right? This area right here. But otherwise, I'm expecting it to fail. Now, what does that mean in terms of range? That's quite a bit of range on the buy side, so I expect it to get exhausted. If it gets anywhere near the 42.21, I expect it to get exhausted. Scenario 3, because we are in a gap, scenario 3 is open, responsive right away as folks take cash off the table who are short, responsive right away, peters, and then we get an impulse down through the low, and then we really start pushing our way into the 50, the 150. That's the initiative. That's the initiative play. So this is balance, this is responsive, this is initiative. If we see that it pulls up and it impulses down, please do not get long. It is moving away from a gap zone after failing to the downside. It is just, pardon the term, unless it's very short-term scalps, it is just dumb to fight this setup. So I have no waiting on which one of these will play out. I'm expecting scenario one is always the higher probability play. I'm expecting us to balance, but I am happy to see either one of these because there's quite a bit of distance that needs to be covered if we get scenario 2 or 3. Okay, don't get too tied up with what you need to see. Don't get too tied up with your risk, with your stops. Take your stop and move on. Don't fight the market. Good luck, and I'll catch you tomorrow morning. Take care.